Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, September 6th, and then we'll see how things look for Thursday, September 7th. We had another down day, and we're getting to that tipping point now where we were positive and working off a short-term overbought condition. Now we're starting to weaken a little bit more to the point where, okay, are we going to keep going and get more negative, or are we finally going to find some support and be able to bounce up off of this? We had a really more significant down day than what you would have thought. We're still below average with volume, and we're in that weak seasonal time now. So now we're just waiting to see if things can recover. Please be aware that in the upcoming week from Monday through Wednesday, September 11th through the 13th, I am going to do the second session of the free online course. It'll be 1 hour each day, Monday through Wednesday. On the first day, I'll go through my consensus approach philosophy behind technical analysis. Then on the second day, and possibly a little bit into the third day, I'll deal with some strategies. And then I'll finish out the third session talking about support and resistance. I had originally thought of streaming this on YouTube and Rumble. That wasn't working out so well, so I'm going to go ahead and do it in Zoom. I will be posting the link for that in the community tab on my YouTube channel. So if you're interested, please feel free to check that out. It will be recorded in case you miss it or in case you want to rewatch it. Let's go back and talk about what happened. We did have a lower open, but it wasn't really a gap. We saw a lot of the weakness come in right after the open. Prices fell down below the daily pivot at 45.02. So we were back down below 4,500. We were already below that, but the daily pivot was set a little bit above 4,500. We fell down below S1 at 44.90. We kept going down below S2 at 44.84. And because Tuesday's session didn't have a really wide gap, that meant the resistance and pivot points and support levels were pretty close to each other. And so that's why we hit S3. We actually made it down to S4 eventually, but then we fell through S3 at 44.66. We kept falling and we bottomed slightly below S4 at 44.48 before rebounding, and we closed at S3. So we were down 0.7% on below average volume. Now it is picking up both in Tuesday's session and on Wednesday. We're getting almost back up to average, but we're not really exceeding that yet. The technicals, we're hanging in there positive for right now, but we're showing some weakness. We've worked off this short-term overbought condition. We don't have any more list for that right now. So we're just wondering, are we going to tip down or tip up from here? It's about inflation and interest rates, and that's what was happening in Wednesday's session. We had oil continuing to go up, which is producing some inflation concerns. We have interest rates going up because that's what happens in an inflationary environment. And then those things together are producing these growth concerns about, okay, what's that going to do to earnings going forward? Some comments. The S&P closed below its 50-day moving average at 44.75. We had been able to recapture that last week. Well, now we're down below it again. Rising interest rates and higher oil prices continue to act as headwinds for stocks. The 2-year note yield really rose. It started out at about 4.95%, and then it ended up closing at 5.04%. And then the scenarios kind of staying a little bit the same right now. What freaked out the bond market and made interest rates go up was the ISM report that came out was stronger than expected. And now we're back to this other side, that the economy might be stronger than they originally thought. So that's going to keep rates higher for longer. And perhaps if it keeps showing some strength, the Fed will have to come in and raise interest rates again. We're also at the same time concerned about what's going on in China with their weakening economy, because so many companies do business with China, and oil is causing concerns. That's more inflationary, because yesterday Saudi Arabia and Russia came out and said, nope, we're going to cut oil production. We've been doing that already. Well, we're going to keep doing that even some more. The dollar was up and interest rates were up. The yield curves that we follow are still inverted. Sentiment ticked down. It had been at 59. It came in at 56, but it's still positive. Our trend is not really changing all that much. It looked like we were shifting more positive. Now we might be shifting more negative. In the meantime, the ADX is suggesting that we're continuing to be in a trendless environment because both ADX charts are below their moving average and they're both below 20. Our bias is negative, and I've kept our momentum at mixed. If we have another down day, it'll get switched over to negative. But since we had the down day, the bias is negative. But for right now, the momentum remains at mixed. We had the weekly MBA mortgage applications index come out. That was down 2.9%. Last time it was up 2.3%. The trade balance came in a little bit better than expected at just a mere minus 65 billion. They had expected a minus 68 billion. Last time it came in at a minus 63.7 billion. The S&P Global US Services PMI, the final reading, they actually ticked it down from the preliminary reading. It came in before at 51. Now it got revised down to 50.5. This was the big one. The ISM non-manufacturing index came in stronger than expected at 54.5. Above 50 means expansion. Also, it's more than what the market had expected at 52.4. Last time it came in at 52.7. Here's a chart of the mortgage applications index showing the decline that we saw the previous week. Then we're looking at the nominal trade balance. Nominal just means a raw number, not taking inflation into account, where it's continuing to go up on a month-over-month basis. Then we look at exports and imports on a year-over-year basis, where they had been declining, and now they're starting to turn up. There's not really a concern on this chart right now. The blue line is showing exports going up a little bit as well as imports. And then the trade deficit in billions showing how it did decrease slightly over the last time, but it continues to be negative overall and has been for decades. Then we have the US Services PMI, which is showing a decline, but it's still above 50. And then here is, I'm gonna have to move this. Here's the ISM Services Index, where we're going back up with the prices. That's producing some inflation concerns. The total chart is the blue line, and that's continuing to advance, which is suggesting that maybe we're seeing some improvement economically. And then we're keeping an eye on this. This is the average of the VIX from 1990 to 2022. That's the blue line, which continues to go up, which could be negative for stocks. We're going to watch this and see, is the red line, which is what we've been doing so far in 2023, is that going to continue to follow this basic model? Looking at the Ulcer Index, which continues to drop even with the down day. This is just one of the fear gauges that we look at. Here's the intraday chart, where we didn't really gap all that much, but we did open below the daily pivot, below the unchanged level, below S1, S2, came down to S3, fell all the way down to S4 before we finally hit some kind of a bottom, came back up, and were able to close at about S3. In yesterday's video, I pointed out that, isn't this potentially positive, where growth was really outperforming value? We gave all that up in Wednesday's session. So now we're not looking as positive as we had been. And then looking at the growth to value ratio, it ticked down a little bit after it was trying to break out. It's still hanging in there for right now, but we want to see more follow through with growth outperforming value. The VIX did tick up with the line chart and the bar chart with the down day. We're seeing a little bit of an increase still with the VIX of the VIX as people are starting to get a little more nervous about things. This is also looking a little more negative with the 5-period equity put call ratio. It's starting to go back up again, and we want it to decline for things to turn more positive. If it keeps going up, that would keep things more negative. And then the VIX to VVIX ratio continues to turn up as well. When it's declining, that's more positive. And the longer term look at the 253 simple moving average of the equity put call ratio, it's continuing to go up as well. So this is not really positive for the market right now on a more sentiment basis. The advanced decline ratio did decline based on price and volume, but we're still above the moving averages. The new lows showed a bit of an expansion, and we saw some contraction with the new highs, and they're really starting to fall off. So that's causing our 5 period to roll over, but it's still positive, and our 10 period is beginning to flatten out. This is more negative too. The accumulation distribution, which tries to measure the smart money, is continuing to fall below a declining moving average. And looking at the advanced decline line studies, we're seeing more weakness with the NYSE common stock. We're just a little bit below the moving average with the S&P, a little bit above the moving average with the mid caps, and seeing more weakness with the small caps. The shaken money flow, also trying to measure what's the smart money doing. It had been improving, but now we're seeing this start to show more weakness. Not really trending right now with our intermediate term ADX chart. We're below the moving average and below 20. The green line is coming down, the red line's going up, and they're just about ready to cross. And we're seeing almost that same thing with the short term ADX. Below the moving average, below 20, green line coming down, red line going up and getting ready to cross. On the daily chart, we had been holding up above the 50-period moving average. Well, now we've dropped down below that. We did come back down to this other pivot level, which right now seems to be providing support, but any more weakness out of this is going to not really help our technical picture. On the bottom, we did see volume pick up, but it's still below average. Looking at our 20-period double and triple exponential moving averages, we had been hanging out okay above these. Well, we broke through them in Wednesday's session. Also, seeing some more weakness with the 50-period double and triple exponential moving average. We're coming down to the red line, which was on the bottom, and now we're starting to break this level of support. The go-no-go system, haven't followed this in a while. It actually switched to a full-blown negative no-go, which is the purple line here, just showing the weakness that we've been seeing. The highest high, lowest low values were coming down below the midpoint after we had been seeing some improvement. TTM squeeze, though, it's continuing to go up. So this hasn't really picked up what is happening, at least in the short term. The McClellan oscillator for the S&P is now dropping below zero. If this stays below zero, that's going to turn the next chart, our summation index, back over, and it's already starting to roll over based on price. It's still weakening a bit, but continuing to advance based on volume. The Elder Impulse system for the S&P is switched from neutral to negative. And the NYSE McClellan oscillator is also dropping below zero. That's turning more negative. This is a broader measure beyond what we look at for the S&P 500. So for the summation index for the NYSE, based on price, we're starting to turn down, even though it's really hard to see. Haven't quite rolled over yet, but we're showing some weakness based on volume. The mass index, we're wondering, okay, did this generate a signal? It came up almost to the blue line, has now dropped down below the dashed red line, and that typically means we're looking for a reversal. And the thing that makes this confusing is this line was really going up as we were going down, okay? But then as we had a good week last week, we went back up, but the mass index continued to go up as well. So that's leaving us a little confused as to a change of trend to what? Positive or negative? So we have to look at other charts for that. Looking at our PMO study, with the PMOs that are rising, that's declining. We're turning down with the buy signals and rolling over with the PMOs that are above zero. The Swenlin trading oscillators continuing to show more weakness based on price and volume. With the NYSE bullish percent index, we were showing some improvement. We're still above the 50 point, but we are declining. The NASDAQ 100 bullish percent index, which hung in there pretty well after Tuesday, now it's starting to turn back down after Wednesday. The Ichimoku cloud, we were not able to get out of the cloud, at least on a closing basis. Now we're coming back down into the cloud, wondering if this will still provide some support. The oscillators are still looking good. These are longer term. It takes them a while to shift. The slope and the TSI, even though it's rolling over a bit, they're continuing to be positive. The MACD, the PMO, and the PPO, they're rolling over a bit, but they're still positive. We're turning up still with the longer term TRIX and KST, but if we see more follow through, it could turn these oscillators down. Looking at our 20-period moving average study, we came down to the simple 20-period moving average. That acted as support in Wednesday's session. Can we bounce up off of that, or are we going to fall through it? Looking at the 50 period, we also came down to the exponential moving average. That's the blue line, and found support there. And then we're able to get back just a little bit below the 50 period moving average. So that's when we lost that on a closing basis. Our moving average tree showing pretty much the same thing. Wondering if we're going to hit these 20 or 50 period moving averages. Will they act as support and provide a bounce? If we fall through them, that's going to turn things more negative. Our standard deviations, we're coming right back up to the midpoint right now. So this is showing equilibrium at the current time. Looking at the 20 period simple moving average of the open, high, low, close, we were coming down. We came down to these two middle moving averages, and that so far has been providing some support. Are we going to be able to bounce up off of that or continue to fall lower? The Bollinger Bands were just a little bit above the midpoint now. We came down and that acted as support, and we were able to close up off of that. So far that support level is holding. A few of our chart variations are starting to look a little more negative. The Heiken Ashi is now looking negative, and the Kigge chart still has a black line, which is positive, but now it's pointing down. So that's more negative in the short term. We're also still below this intermediate term trend line. We came back up to it. We're not able to break through it, and now we're starting to fall back down from that level. The MACD on the weekly chart still continuing to show some weakness longer term. And the growth to value ratio for the S&P, it ticked down just a little bit after it had been able to break out in Tuesday's session. We want to see this turn and go back up to turn things more positive. The Dow continues to fall below its 50-day moving average and below this pivot point. And the NASDAQ 100, so far, this is hanging in there a little bit better. We have not been able to break out above this pivot point, but we haven't really broken down yet, at least for now. Where we've switched from being positive with the Qs, which is the NASDAQ 100, over to neutral. We're still looking okay with the momentum, with the PPO looking at the NASDAQ 100. This is continuing to advance. This is a little bit slower. So if we are switching back more negative, it's going to take a little bit longer for this to roll over. The NASDAQ continuing to hold support right at this 50-day moving average and at the pivot level. So that is holding for now. But we're starting to break down below the 61.8% retracement level on the Fibonacci chart. So that support did not hold, at least for now. But with the FANG index, the 50-day moving average is continuing to provide support. Small caps, man, they fell from their 50-day moving average down to their 200-day moving average, and now we're below that. That's the negative side. We do have some support down here, potentially, and we are working off of a recent golden cross. We're also seeing more weakness with the Russell 2000 small caps, dropping below 50 with the RSI, dropping below this support dash resistance line. So that's showing negativity, but we did have a recent golden cross. The MACD is still positive, but is rolling over. The mid caps continue to fall. They're kind of in between their 50 and 200-day moving averages. Mid-cap growth versus value, this is hanging in there for right now, where we had a significant down day with the mid-caps, but the growth continues to outperform the value. This is where we're seeing a little bit more weakness too. The Dow is coming back down, but still above this breakout point. However, the transports are showing more weakness and starting to break down as we come back down to this other breakout level, which was a short-term high. And we saw a little bit of a tick up in the utilities. The transports to S&P 500 ratio continues to decline, and that's turning things more negative. To turn things more positive, we want to see the ratio go up. Interest rates continue to go up on the 10-year yield. We're getting close to that 4.3% area. And when interest rates go up, that means prices are going down. We've had a recent death cross here. We're dropping below 50 with the RSI, rolling over with the MACD, although it's still positive. But when you compare riskier bonds like junk bonds and more risky companies that issue bonds and compare them with more conservative bonds, the ratio continues to go up, meaning folks are still favoring riskier bonds. They're willing to take on that added risk to get a greater return. This is a chart, haven't shown this in a few days. This is the ratio. As long as this is going up, that means there's uncertainty about interest rates, and that's kind of what we're dealing with right now. The S&P to utilities ratio continues to go up. It ticked down just a little bit, but often this gives good support to the S&P. We're just not seeing that. And also the Staples to S&P 500 ratio ticked up just a little bit after it really declined on Tuesday. This often gives support as well, but we're not seeing any follow through at this point. Looking at Tom Bowley's research, where September is the worst calendar month, real estate tends to not be hot, and that's really under pressure now, where industrials tend to be hot. We're kind of moving out of this initial period where we were seeing some positive historical action. We're coming more into this intermediate term from the 4th through the 10th, where we tend to see some weakness historically based on his research. Then we see a little bit of a bounce later in September, only to see weakness going into the latter part of the month. And shoes, footwear, I guess, and airlines continue to be pretty strong industry groups during this time. So our outlook for Thursday, we're still dealing with earnings reports. The technicals are positive, but now they're starting to show more weakness, but we're still not trending. We will get the weekly jobless claims, the revised number for productivity, as well as the revised number for unit labor costs. The geopolitical events right now for the market, it's inflation, interest rates, and growth concerns. What's oil doing? A little bit of a concern with earnings, and is the Fed going to come out and say anything? Here's the updated economic calendar showing what's coming out on Thursday, and then on Friday, we'll get the wholesale inventories and consumer credit. Looking at the stock traders almanac statistics for September 7th, we're neutral to negative with the Dow and S&P, where we're neutral to positive with the NASDAQ. And we're wondering as we chop around in a pre-election time, is this that little bit of weakness that we're seeing? We saw a little bit of a bounce last week, but not all that much to really turn things more positive. We're also wondering as we're coming into September with the NASDAQ, where we often see some strength around about this time, but then we see weakness coming into the latter part of the month. With the S&P 500 during a pre-election year coming into September, have we gone beyond this upward move and now we're starting to come back down? And then the last chart going back to 1950 and looking at only pre-election years, we're only up 33.33% of the time. So our scenarios, not going with the down one yet because we're not trending and our technicals are still positive and hanging in there for right now. But if we see another down day, that could switch things. We're kind of leaning towards the positive side, but we're going against the technical picture. So that's making things weaken, but we're still not trending that way. So if anything, we would lean to the neutral side where before we had been defaulting to the positive with the green line being on top, but now they're pretty much right on top of each other. So we're wondering if we're going to see that shift in trend. The warning signs, the long-term trend signals, we're still below those long-term trend lines on the weekly S&P and NASDAQ 100 charts. We have not been able to break through those. Seasonally and historically, September is a weak month. The equity put call ratio is turning back down. I'm switching this back and forth from the negative warning signs to the positive chart. The long-term equity put call ratio is turning up, and that is negative. The cumulative new highs and new lows for the NASDAQ are still showing weakness. The 3-month yield is above where it was in 2007. It was unchanged, but overall it has been rising lately. And then we're dealing with earnings season. The positive signs, we still have seasonality and setups that I discussed in the weekly video. Those remain in the background. The daily chart for the special K is still positive, where the weekly chart is negative. We're still above the downtrend channel upper line. The risk on posture is holding up for right now, and at least for so far, it is. The S&P 500 oscillators are turning more positive. Now, we see follow-through weakness that could change that story, and the NASDAQ 100 is also turning more positive for right now. The S&P is outperforming utilities. The Staples to S&P 500 ratio is declining. The Russell, the small caps, and the mid caps do have recent golden crosses that were generated. Small and mid cap growth continues to be positive. The financial sector generated a golden cross not very long ago. The parabolic SAR is still positive, and the Copic curve generated a buy signal last week. So our conclusion, we're positive, but now we're leaning more towards the weakness side, but we're still not trending. We can say that same thing with the short term and intermediate term, but we're still above the 200-day moving average in the long term, so we remain positive. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.